Hello, everyone. We are back with part two of our series, Why Investors Are So Miserable. Why do people feel worse than they did during the apex of the COVID sell-off? And if you missed part one, I encourage you to watch that. It was basically people FOMOing into some of the work from home stocks, the COVID economy stocks, tech stocks, as reason one, people feel worse than they did during the COVID sell-off. Today, we're going to talk about reason two, which if you're retired or if you're a risk-averse investor, this one probably is more meaningful to you. So without further delay, I'll share my screen here and we'll get into part two, why people are so miserable. And this probably affects most retirees, if I had to guess. So let me just minimize this. Hopefully you can still see me and see my screen. So this is about asset class correlations during times of market stress. So when I say asset class, I mean in the broad sense, equities, fixed income, real estate, commodities, and then sub-asset classes would be like US large cap, US small cap, emerging market stocks, corporate bonds, government bonds, high yield bonds. So we have the overarching asset class, the sub-asset classes, which tend to move together during times of stress, which that's bad. When I say move together during times of stress, that's usually down. So in normal market environments, different asset classes tend to act differently, which is good. It doesn't do you any good to own 15 asset classes if they all do the same thing. But when the stuff hits the fan, markets are panicking, investors often don't discriminate. They sell everything, hence correlations moving to one. And when that starts to break down, diversification breaks down, which can affect risk-averse investors and multi-asset portfolios in a bad way. So let's see what that actually looks like. And again, this is why people feel so bad right now, because stocks and bonds are moving down together. So what I did here was I just threw some equity asset classes in here, mixed with some government bonds, the US 10-year, corporate bonds, and then lower quality corporate bonds. And then you see US large cap here. So this is basically the S&P. This is basically the EFA foreign stock index. Let's go back here. So you can see the annual returns, and this is just, January and February of this year. But you can see everything is down together. You know, some assets like the 10-year Treasury is held in there on a relative basis, only down about 2% as of the end of February. Corporate bonds are behaving more like stocks, and high yield bonds are somewhere in between. And you can see the return numbers here and the drawdown here. Okay. So in 2022, unfortunately, there's been few places to hide. Aside from energy stocks and gold and commodities, everything else is in the red. So that doesn't feel very good, again, if you're a multi-asset class, risk-averse, diversified investor. And this is pretty rare. So this is just stocks and bonds for the month of January and February, both being down. And I shared this in my month-end commentary video. And if you're a client of Pure, you probably saw that. If you're not a client, you didn't see it. But this is a pretty cool data point in that this goes back 80 plus years. And this shows just how rare it is for bonds and stocks to be down together for the first 2 months of any calendar year. So 1978, 2009, and lucky us, 2022, you can see the S&P and the long US Treasury bond both being down together. That's occurred only 3 times. And then what this does, it shows us what performance is going forward when this happens. So again, sample size is pretty small, but it's kind of nice to see stocks performing decently well. You know, that's kind of a silver lining in a world starving for some good news, and bonds are more mixed. You know, again, this is not me saying this is what happens next. This is just a evidence-based view on stocks and bonds are down together for the first 2 months of the year. So what I'm telling you is what's happening now with stocks and bonds down together is more of an outlier than a normal occurrence. I hope this is not too small. What I'm trying to show here is this is basically a matrix of all these different asset classes. And we're using exchange traded funds or ETFs as sub-asset class proxies. So you see this is the S&P US large cap. This is a mid-cap ETF for US mid-cap stocks, so on and so forth. This is international. What I've done is I've highlighted the bonds here. So this is a snapshot of the US bond market, 1 to 3 year treasuries, 7 to 10 year treasuries, longer dated treasuries, TIPS, which are inflation protected bonds, and these are corporate bonds. And what I want you to pay attention to, this can be a little overwhelming, but this column is US large caps, right? You see IBV, S&P 500. And what I'm looking for is how closely these asset classes, these bond asset classes, move in relation to the S&P. Now, positive numbers here means they're somewhat correlated, right? So when the S&P is up 10%, bonds might be up a little bit, okay? When the numbers are negative, that means the assets move opposite of each other. So if something has a correlation of -1, the S&P is up 10%, that asset class with the correlation of -1 would be down 10%. All right? Historically, bonds move the opposite of stocks. Given a large enough sample size, bonds tend to move opposite of stocks, which means that's a good diversifier. So you want asset classes that behave differently. Negative numbers means an asset class moves differently than whatever you're comparing it to. So just looking at some of these equities, like it makes sense that IJH, the mid-cap benchmark, would move very closely with the S&P. You see the correlation is almost 0.91. So US large cap, US mid cap, that moves almost 1 to 1. Okay. What's interesting to me is a lot of these numbers, although they're pretty small, they are positive, meaning bonds are moving more with stocks. And you can see the highest positive correlation number here is with the 1 to 3 year treasury with the small cap index. But I don't really care about the specifics. What I'm looking for are positive numbers for bonds in relation to equities. And you see that circle here. If I was to circle this, there's a lot of positive numbers here, which is really not what you want to see. Going to longer dated bonds, longer dated treasuries and TIPS, you're seeing some negative numbers here, which is okay, but they're still barely negative. Like this is basically modestly inversely correlated. All right. And then you look at the return numbers for the first 2 months of the year, and you can see pretty much everything is negative, like I mentioned, except for commodities and gold. So US large caps, various flavors of fixed income, they're all negative. So this doesn't feel very good, which is why investors are so beaten down. Okay. So now instead of looking at just 2 months, let's look at a wider lens, a wider time period, and show you what a normal correlation matrix looks like. Okay. So this goes back, our sample size is roughly 15 years, give or take, from 2007 to 2022. And look at this. Every single one of these bond asset classes is negative. Okay, this is normal. This is more normal, right? So as stocks go up, bonds go down. As stocks go down, bonds soften the impact and go up in value. And then in the meantime, you're getting paid to form of bond interest payments. So this is what is supposed to happen in rare instances, like we've just seen 3 times over the last 70 or 80 years, bonds and stocks move down together. That's why people feel so bad. So although the S&P, as of this recording, this is the 17th of March, even though the S&P is down 8.5%, people feel worse than they did when the market was down 30+% because bonds aren't producing the diversification benefits that they usually do. And then the first thing that I recorded is a lot of people FOMO'd and chased performance and piled into Cathie Wood's ARK fund. They piled into tech stocks. They piled into work from home themes. And most new investors that we speak to, or new prospects that we speak to, are doing much, much worse than the overall markets because of that fact of FOMOing into the best performing names of yesterday. And then this is the other part of it. The bonds really haven't been a safe haven as they usually are. So hopefully this reverses. Once we get some clarity on inflation and the Fed and oil prices and wheat prices and all these different things, this is a messy time. I hate to draw absolute conclusions based on what's happening. This is not really a business cycle, in my opinion. It's a post-pandemic cycle that's disjointed from every metric that you could possibly look at. So I think it's a mistake to look at historical metrics, historical business cycle metrics, to look at past Fed actions and draw absolute conclusions in this environment, just because the data is so messy. But what we would want to see ideally is for bonds and some of these diversifying asset classes to start to mitigate your biggest risk. Most people's biggest risks in their portfolio are equities. That hasn't happened this year, which is why people feel bad. So I hope you enjoyed this. I hope you learned something. Feel free to give me some feedback, comment, suggest what you'd want me to cover next time. I appreciate it. Take care.